Imagine you just lost $5,000 in a single afternoon. Not because the market was rigged, not because you had bad information, but because of something happening entirely inside your own head. That is the real reason most beginners lose money in the market. And by the end of this video, you will know exactly what those mental traps are, and more importantly, how to stop falling into them. Because here's the thing nobody tells you when you first start investing. The biggest threat to your portfolio is not inflation, not interest rates, not even a market crash. It is you. Our brains were not built for investing. They were built for survival on a savanna thousands of years ago. Back then, if something looked dangerous, you ran. If something felt good, you chased it. Those instincts kept our ancestors alive. But in the stock market, those same instincts will absolutely destroy your returns. Psychologists and behavioral economists have spent decades studying exactly how and why people make terrible financial decisions. And what they found is shocking. It is not random. The mistakes investors make follow predictable patterns. These patterns are called cognitive biases. And today we're going to walk through the most dangerous ones, one by one. Let us start with loss aversion. In the 1970s, psychologists Daniel Kahneman and Amos Tversky ran a simple experiment. They asked people whether they would rather have a guaranteed $50 or flip a coin for a chance to win 100. Most people took the guaranteed 50. That makes sense. But then they flipped the scenario. Would you rather lose $50 for certain, or flip a coin where tails means you lose 100 and heads means you lose nothing? Suddenly, people started gambling, even though statistically both choices were equal. Why? Because losing feels about twice as painful as winning feels good. And in investing, this means people hold on to losing stocks way too long, hoping they will come back, just to avoid locking in that painful loss. Now let us talk about herd mentality. Picture this. It is 1999. Everyone around you is getting rich off .com stocks. Your coworker just made $20,000. Your uncle is quitting his job to day trade. What do? If you are human, you feel an almost physical pull to join in. That pull is herd mentality. It is the same instinct that made our ancestors follow the group away from predators. In the market, it makes people buy at the very top of a bubble, right before it bursts. And it works in reverse too. When everyone is panic selling, that same herd instinct makes you want to sell as well, even if the fundamentals have not changed at all. Here is one of my personal favorites: overconfidence bias. Studies show that around 80% of drivers think they are above average. That is mathematically impossible. The same thing happens with investors. After a few wins, people start to believe they have cracked the code. They take bigger risks, they trade more frequently, they ignore warning signs. Research by Brad Barber and Terrence Odian found that the more frequently people traded, the worse their returns were. Overconfident traders were literally making themselves poorer by believing they were smarter than the market. The market does not care about your confidence, it only cares about the facts. Then, there is confirmation bias. You buy a stock. You are excited about it. Now, every piece of good news you read about that company feels like proof you were right. But every warning sign, every bad quarterly report, every analyst downgrade, your brain quietly filters it out. This is confirmation bias. We subconsciously seek information that supports what we already believe, and we dismiss information that challenges it. It is why smart people can hold on to terrible investments for years, constantly finding reasons to stay in. The solution is uncomfortable, but simple. Actively search for reasons why you might be wrong before you invest a single dollar. Anchoring bias is sneaky. Say a stock was trading at $200 last year, and now it is sitting at $100. Sounds cheap, right? But that original $200 price is an anchor. Your brain is using it as a reference point, even though it has nothing to do with what the stock is actually worth today. Companies use anchoring all the time. That is why prices end in 99 cents. The anchor of the round number makes the price feel lower. In investing, anchoring causes people to buy falling stocks simply because they used to be higher, without asking the real question. Why did the price fall in the first place? So now you know 6 of the biggest psychological traps: loss aversion, herd mentality, overconfidence, confirmation bias, and anchoring. But knowing about biases is only half the battle. The other half is building systems that protect you from yourself. Warren Buffett once said that the most important quality for an investor is temperament, not intellect. The best investors are not the smartest people in the room. They are the ones who have learned to create distance between their emotions and their decisions. Things like automatic monthly investments, written investment rules, and long holding periods are not just strategies. They are psychological guardrails. Here is a practical framework you can use starting today. Before every investment decision, write down 3 things. 1. What is your actual reason for buying or selling? 2. What would have to happen for you to know you are wrong? 3. Are you making this decision because of data or because of emotion? This simple exercise forces your rational brain back into the driver's seat. It creates a paper trail that holds you accountable to your past self. Most people skip this step. They go on gut feeling, they follow the crowd, they anchor to old prices, and then they wonder why their returns do not match their expectations. The investors who build wealth consistently are the ones who treat their own psychology as seriously as they treat market research. Your emotions are not your enemy. They are just data points that need to be understood, not obeyed. Every bias we talked about today, loss aversion, herd mentality, overconfidence, confirmation bias, anchoring, they all exist because your brain is trying to protect you. The trick is learning to work with that wiring, not against it. The market rewards patience, discipline, and self-awareness more than it rewards brilliance. If this video helped you see investing a little differently, the next step is simple. Start applying even one of these ideas to your next decision. And if you want to go deeper, there is plenty more where this came from. The playlist is right there.